What would you do if you were me? This is one of the best questions you can ask someone after you've let them know about your situation and you've worked on some planning. What would you do if you were in my situation and you were looking at this policy? Tell you what, that's something that has helped me and our company so much when we approach a policy. If we're designing it, when we're speaking with someone, they provide information as to what they're looking for. Once we have an idea of what they're looking for and hear some of their goals and see exactly what they want to do, asking that question, them asking us, or us saying, if I'm in your position, here's what I would do. That's one of the most powerful things you can do, in my opinion, providing what you would do if you're in their situation. And I'll tell you what's even more powerful, to use that word, is what if what you would do is not in your best interest as the agent. So for example, you're interested in a policy. Maybe you want to transfer $1 million into a policy. I'm going to share a situation that involves just that. But I look at it and say, man, if I was you, like there's no way I would do this. It does not make sense and I would lose a lot of money. Can you truly make that recommendation? Can you say that? Or do you look for a way to try and make it work? This is a problem that can often occur in the life insurance industry. It occurs in a lot of industries, but when you're dealing with people's money, it's very important. So a couple things I want to hit on here. Number one is something that will help in all situations, staying calm. So this is for you, the policyholder. Staying calm is very, very important. Now, imagine something with me. I'm going to explain a real life situation that happened. Stay calm. We'll assume you already took out a policy. You put in 7 figures into this policy over a short period of time, and you feel like the original agent that sold you that policy took advantage of you. You're discovering things about your policy that you were not told up front. You're seeing a bill on your policy on your online portal for 6 figures, over $200,000. You're looking at your situation, you're looking at your policy and saying, this is not what was told to me up front. What's going on here? I'm getting really concerned because I paid all this money in. I see a bill where I was told I don't have to pay anything else. I see all of these fees and expenses. I don't remember seeing that. How frustrated or how upset? Where are you emotionally? Are you calm? A lot of times we kind of get thrown into a downward spiral in a case like this where we start panicking and making assumptions. I know I've done it with things. I think everybody does it with different aspects of their life. A lot of times it happens with finance and money, but it can happen with anything. So to provide some details on this situation, I'm going to share an example of something we experienced. Is someone was stuck in a bad policy, what he thought was a bad policy. It was an indexed universal life insurance policy. And by the way, when it comes to IULs, that's not something our company does. We do not specialize in them. Our company has a laser focus on whole life insurance products that are set up for maximum cash value. That's what we're very, very good at. So when it comes to IUL products, yes, I do have some experience with them, just being in the industry for a while, but I am by no means an IUL expert. So I want to make sure that that's very clear up front. What this individual did about 4 years ago, he funded the policy at $375,000 per year for 4 years, which is a total of $1.5 million. So that's a lot of money to move into a life insurance policy. Now, the original plan was to fund it at $375,000 for 4 years, and that's it. He did not want to pay anything else into the policy after he got that $1.5 million in. He reaches out to our company, very concerned, panicking, because he goes on his online portal and he sees on his policy anniversary date, there's a premium due of over $200,000. So think of it this way. You take this policy out, you put a ton of cash into it. When you took that policy out, you were told you don't have to pay anything else. Then you see on your online portal with the insurance company, not the agent, but the source where that policy is positioned, a bill for $200,000. You also see all of these additional expenses. there are expenses of between $60,000 and $80,000 because IULs will disclose this. What goes through your mind? You're panicking? A lot of times people will panic here. This happens again with all financial products. So again, staying calm when you feel like someone took advantage of you. This is important. And I used to panic all the time, by the way. Staying calm, experience has helped, and just really looking at situations, trying to take a step back, calm down, and think, all right, panicking is not going to do anything. How do I look at this situation properly? And then as the agent, how do we make sure we provide the proper advice here? It's so important to do this. The root problem here was not the fact that it's an IUL or was set up horribly or anything like that. The problem was this. The details were not explained up front. As the client sent us the initial email, then we had a meeting with him. It was evident that he did not understand the ins and outs of the product. In fact, what he originally thought he was getting, and then when he received the final contract, were two different things. So there's a red flag right there. But he continued to proceed with it, but details were not provided up front or explained up front, or he did not have an understanding, because I don't know the original agent that sold the product or anything like that. So he very well could have explained everything up front, but maybe it was over a phone call and the client forgot. We've all been in situations like that. But lack of understanding, lack of clarity, that's the root problem here. So what happened? Before he connected with us, he spoke with another agent who proposed an immediate solution of a 1035 exchange. A 1035 exchange is a tax-free transfer of cash value in a life insurance policy, in a current product, to another life insurance policy. You also have the option to 1035 exchange, transfer cash value in a life insurance policy to an annuity instead of a life insurance policy. So, A, he was shown transferring the IUL to a single premium whole life insurance policy, and then B, transferring the IUL to an annuity. Now, how much has he paid in? $1.5 million. IULs have what? Surrender fees. So he has what is called an accumulation value, but he also has a surrender value. So the accumulation value on his account is about $1.3 million. But the surrender value, meaning if he executes a 1035 exchange or cashes out and says, I'm done with this, is about 1.1. It's $1,050,000 right now, around that dollar amount. So if he's got $1 million in surrender value, like the net value that he would get or be transferred, and he paid in 1.5, what does that mean? It'd be a $500,000 loss. Would you do that? No. When you look at the numbers, it's not going to make sense. Before we even run the numbers, it won't make sense. Of course, we still could, but it does not make sense. He's in his late 60s now as well. So what they looked at was first an IUL to a whole life insurance policy and then to an annuity. And the strategy here was to use the annuity to feed the new whole life insurance policy. The reason for that, or the purpose behind that, is if you spread those payments out for a longer period of time, call it 5 to 10 years, sometimes you can purchase more death benefit. So they were attempting to match what the original policy's death benefit was, which was over $4 million, which there's no way you could do that. And again, that's without even looking at the numbers. If you'd like to see videos where we really analyze 1035 exchanges, I would check out the video above. But those solutions were provided. So what I'll say about that, those solutions there are sales concepts that I was trained with years ago. But here's the concern that I have with them. And this concern comes from my own experience. I'm not saying anything about the other agents, nothing like that, because again, I don't know them and the amount of work that they did. But with the sales concepts, often as an agent, we're trained about a sales concept. And the training is, this is a fantastic solution. When you run into clients that have a situation where their policy is not performing, you can immediately look at a 1035 exchange, look at the non-guaranteed side of the illustration, and you can show, look at how much more value you'll have with our solution compared to your current strategy. And there's a big problem with that, in my opinion. The problem is we're looking at illustrations, not actual results. And what often happens, what will happen if I 1035 exchange an existing policy into a new one, I'm undergoing new insurance expenses. I've got a new guaranteed rate if the guaranteed rate with the new product is different than the old one. There's a lot of things I've got to look at that go beyond just the basic illustration. And if I overlook that, what often happens here is the new policy underperforms, meaning an individual ends up with less money, almost all the time up front, but it's sometimes long-term too, on a guaranteed and potentially non-guaranteed basis than what they would have if they just kept that original policy. So it's important here to really do your due diligence, or an agent, run an analysis, look at everything. This is going to take time. But when you're working with people's money, especially $1.5 million, and you're looking at different strategies, I wouldn't be quick just to jump to a solution here. The thing is, if he's got $1 million in cash value, he's going to roll that over and potentially pay more premiums. He might not, he doesn't want to. But if you do that, I mean, it's $1 million being rolled over. It's going to be a decent commission. So it can be very, very exciting there to capture the deal, right? The excitement often goes through any agent's head. I know it does with me. But at the same time, looking at it and going back to that main question, what would you do? What would you do if it was you? Would you recommend that? Knowing that if an analysis is run, there's a good chance that you could have less money from start to finish than what you would if you kept the policy. I don't know about that. Like, no, I wouldn't do it. So you can't make that recommendation for someone else if you wouldn't do it yourself. But here's really the steps to take here. Number one, when you're reviewing the policy, and this is what we did with this individual who's a really nice guy, provide clarity. So, providing clarity, what we looked at was the original policy. He's nice enough to send this. The original full contract with the illustration in there that showed that $375,000 for 4 years. Okay, that's what that looked like. And it showed beginning the 5th year, 0. His concern is that he sees a premium due for $200,000 in year 5. He's like, I don't have this right now. I don't have to come up with this. And then he sees expenses on his policy. He feels that if he doesn't pay it, that the policy will have to pay for itself. And will that result in his cash value going down $200,000? He asked, if I'm right now at $1 million in cash value, and I don't pay this $200,000, is it deducted from my policy? And then next year, I'm going to have $800,000 in cash value? The good news is no, that will not happen. So the original illustration, what you'll see here is in the 5th year, you paid in 0 and your cash value increased. It was, call it 1 million. And then in the 5th year, with 0 out of pocket, you didn't pay anything, it's worth 1.1 million. These weren't the actual values, I'm just using round figures here. So as we can see in the illustration, again, this was the original one. Here's your value in year 4. Then year 5, 0 payments, those insurance expenses and those charges, everything's still there, but your net value is increasing there. So providing clarity around what he has is so important here, because we see a premium due. What happens if I don't pay it? Is my policy going to lapse? People panic. I've had friends panic in cases like this. I did too when I didn't know anything. No, it will not. You can easily not pay the policy, and it will continue to increase, which is nice. You do not need to pay that. What we want to do is elect the policy to pay for itself. With a whole life policy, this would be referred to as a premium offset, where we are allowing the dividends and interest to pay that premium internally. We want the equivalent with an IUL product. There's some other options we can look at as well, such as reducing the death benefit in the future to try and enhance the performance. But to provide clarity and really peace of mind too on the topic of staying calm, you're good. The value will continue to go up, and here's what it looks like. Okay. Now on that same or on a similar point, performance. And this has to do with IULs. We had the original illustration, and then we had the performance through year 4. He's about halfway through year 4. And the actual performance is less than what was illustrated. It's underperforming. So when looking at a new illustration, what we want to look at here is request an in-force illustration, which his agent will have to do, or he will have to do it, because we're not the servicing agent. This is instead of a 1035 exchange. But see what an in-force looks like. And what I'm going to request are the guaranteed values, the current values, which is based on hypothetical performance, and then also alternate values, which if the current is using an assumption of 6.5%, the alternate might use an assumption of 4.5% or so. So we've got a more conservative crediting rate applied to that illustration every year, which I like to look at. And we see that the actual performance from day one has performed closer to the alternate side of the illustration, meaning the more conservative numbers. It's been a little bit less than that actually. It's only 4 years into it too. But from a performance standpoint, we can see what he's done thus far, and we see what it looks like moving forward. And really what I want to see is, does that cash value continue to increase? Because what's going to happen with an IUL, especially if you're looking at the alternate values, in his case, it's going to go like this, and it's going to begin to teeter out, and then it's going to go down. The reason why this often happens is because you've got the insurance expenses exceeding the guaranteed rates. Now, if you talk to an IUL pro, right, someone who has a lot of experience with it, there are levers you can pull, such as reducing the face amount in the future in order to lessen those expenses and improve the long-term performance of the policy. But what you're up against with the IUL is expenses that will continue to increase, and they're going to exceed the guarantee. So this is why often on the illustrations we see it going down. But for now, it'll continue to go up, and it's going to go up for a while. Now we also want to hit on the surrender fees, because that's a big one right now, and this is a big reason why it doesn't even make sense to look at a 1035 exchange, because he's got about $1 million in cash surrender value. So if he does look at a 1035 exchange, that's what the agent would have to work with to try and fund the new policy. And he paid in $500,000. So how long does it take to recoup that? And he's 67 years old now? Like, that's a long time. There's the question, when would you recapture your principal? So what's important to look at here, and this is what we recommended, is looking at the guaranteed values and non-guaranteed values with his current product, looking at 2 in-force illustrations, which have 0 out of pocket. This way he sees that he does not need to pay anything else in. But then what it looks like if he continues with the original plan, keeping the death benefit at the $4 million and change that he originally set it up with. There's a difference with the in-force illustration compared to the original. We see the policy based on the alternate scale lapsing in his 90s. I think it was early to mid 90s, where on the original one, to go back and reference it, but it looked much, much better. So he sees, all right, those expenses are outpacing these returns here. I want to make sure I look at it year over year. So that's the first thing. And then the second illustration, the second thing to look at is another illustration, but with reducing the death benefit, pulling those levers we referred to earlier. And what we like to do here is provide some instructions for the individual to provide to the client, to the insurance company. This way they can get the proper in-force illustrations or communicate it with their agent. And if it made sense to do a 1035 exchange, we would do it, or we would look at it and we would run the numbers, look at it side by side. We've done that before where it has made sense and it's been a no-brainer for people. Then there's been times it's very, very close. But to kind of summarize his situation, where initially he was not calm, he was very concerned, which was understandable and such. He does feel a bit better now, or at least I got that sense, which is good. But then moving forward, what we're looking at is keep the policy, see if it increases over time, measure it year over year. If it continues to increase, do you recapture your principal, the $1.5 million? If so, when? And then does it stay at that level? Does it begin to decrease at some point in time? We want to make sure we constantly review the policy. Because if we see it going down, maybe even before it hits 1.5, that may call for a 1035 exchange, especially if we see a potential lapse occurring early or something like that. My point is just review the numbers and make sure an informed decision can be made that you're comfortable with and you truly understand. Because what we don't want to do is just propose another solution where he brought up a 1035 exchange, like, hey, can I just do this if I want to get out of it, or should I do this? It's like, no, I wouldn't do that. You can't provide solutions if you don't know the problem. You can't go to a doctor and say, hey, give me some kind of medication, give me chemo when I've got a broken ankle. Like, no, or give me surgery when I've got the flu. It's like, that's not going to do anything. First, the problem has to be diagnosed. So I do hope that this video is helpful, whether you are interested in a policy or if you are in the business. If you're in the business, what I would make it a point not to do is do not assume that that agent did anything to try and take advantage, because that's often not the intent. Whenever someone makes assumptions about you, you probably don't like it very much. Like, what does this person know? So we want to make sure we don't do that to others. This happens a lot when someone prefers IULs or whole life. Like, it happens in the industry. When I came up in the business, the training was that whatever your company sells, beat up the competition. Like, no, don't do that. That's just my opinion, and I'll leave it at that. But try not to assume that someone did that, especially if they didn't know. You could say they should have known, but if the other agent didn't know, we don't want to make assumptions because we don't like it when it is done about us. But with all that said, I do hope that this did bring some value. Let us know if you have any questions at all. And as always, I hope this helps. Thanks so much. Hey guys, Steve here with IBC Global. Thank you so much for watching the video. If you're interested in a whole life insurance policy and you'd like to work with our company in setting it up, please visit our website, ibcglobalinc.com. We would love to work with you. If you have any questions, please leave them in the comments below. And as always, I hope this helps.